Live.
Good afternoon from Singapore, ladies and gentlemen, and welcome to the IBOR Transition Virtual Client Webinar for the year. This is being hosted by Standard Chartered Bank. It is the second session we've held this month and will be the final one for this year. Today, we will provide you with an update on the progress made thus far on the transition away from LIBOR to the alternative risk-free rates. We will also talk you through some of the milestones expected as we approach the deadline of December 2021. We thank you for joining us today, particularly during these unprecedented and uncertain times. Next slide, thanks, Joe. So my name is Kamini Rambausek, and I'm from the IBOR Transition Program. Joining me on the call today is Ryan Goh from our rates trading team, Arpit Mehrotra from the IBOR Transition Program, and Tiek Piao Pua from our compliance team. Before we begin, I'd like to mention a few housekeeping points. As we are using Blue Jeans events to run this briefing session, we will be sharing the slides on screen and all attendees will be placed on mute. If you're having trouble viewing the slides, please expand the screen or move the slider bar, both of which are found at the bottom of your screen. Please note that this is a client-facing session. Throughout the presentation, you may post your questions in the Q&A panel on the right of your screen. Our panelists will pick up your questions during the course of the presentation, and some will be addressed at the end, time permitting. If we do not get to your question, please be assured that we will follow up with you after the presentation. So you should make sure that you sign on with your full name and details. Later this week, we'll also be sending you the link to this our external website where you can access these slides as well as a recording of today's session. So moving on to the next slide, what will we be discussing today? So we want to share with you an update on the regulatory and industry working group development as we progress in the transition away from LIBOR. We'll also walk you through the latest industry updates in the loans, bonds, and derivatives markets, and we'll speak a little on the latest announcement on the consultations from the ICE Benchmark Administration with respect to the LIBOR settings for the 5 LIBOR currencies. To provide an update on the development of RFRs, and of course, we'll also speak about our bank's capabilities, and we'll talk you through the latest stance on forward-looking RFRs as well. You can also expect to get our take on what you should consider in your transition planning and what our next steps are to engage with you as we move into 2021. And finally, we'll do a quick run through of the readiness checklist that we've prepared for clients, along with a few tips to prepare for the transition. Moving on to the next slide. So while it is important to understand the milestones that are coming between now and the end of 2021, it is worth also recapping some of the more important ones that have led us to this point. It was in July 2017 that the FCA's Andrew Bailey first announced that they will no longer compel panel banks to submit LIBOR after December 2021. And a year later, markets were informed by the regulator that they must end their reliance on LIBOR and prepare to move to a world with alternative risk-free rates or RFRs. And over 2018 and 2019, there were market announcements and steer from the regulators on preparing for this move away from the reliance on LIBOR. More recently, and as part of global industry efforts around benchmark reform, the central clearing counterparties or CCP clearinghouses such as the LCH and the Chicago Mercantile Exchange, they've switched the price-aligned interest and discounting. So for all cleared euro-denominated products, the switch from Ionia to Ester took place on the 27th of July 2020, and in mid-October, the discounting switch took place from the effective Fed funds rate to the secured overnight financing rate or SOFR, and that has been in effect since the 19th of October. For the derivatives market, a much-awaited announcement from the International Swaps and Derivatives Association, or ISDA, was made late October, giving this much-needed direction to the market. So on 25th of October, ISDA published the IBOR fallback supplement to the 2006 ISDA definitions and the ISDA 2020 IBOR fallbacks protocol to implement the new fallbacks for new and existing derivatives contracts The supplement and the protocol will take effect from the 25th of January 2021, and Ryan Goh will elaborate a little further on this announcement. It's important to note that regulators globally have strongly encouraged adherence to the protocol, and Standard Chartered certainly has. So given the current market environment and the impact of COVID-19, a common question we're hearing from clients is whether December 2021 is still the deadline for LIBOR transition. And that brings me to the ICE Benchmark Administration announcements that we received in the last 2 weeks, and noted on the very last point at the bottom right of this slide here. So moving to the next slide. So what were these announcements about? So based on feedback and information received from the panel banks and following discussions with the FCA and other official sector bodies, the IBA made 2 announcements in November and published a consultation last Friday on its intention to cease the publication of certain LIBOR settings. So if you look at the table on the slide, the middle of the slide, it proposed ceasing publication of LIBOR after the 31st of December 2021 for all 7 tenors for GBP, Euro, Swiss franc, and Japanese yen LIBOR settings, plus the 1-week and 2-month US dollar LIBOR setting. In addition, it proposed ceasing LIBOR publication after 30th of June 2023 only for the overnight and 1, 3, 6, and 12-month US dollar LIBOR settings. So that's all stated on the slide that you see in front of you. The consultation is open for feedback until the 25th of January of 2021. And after the consultation ends, it is expected that a single announcement will follow shortly thereafter, which will likely announce the cessation of all 35 LIBOR settings. So what does this all mean for US dollar LIBOR? Though it is yet to be confirmed by the IBA, it is now highly anticipated and likely that the US dollar panel submissions will continue for all but 2 tenors until mid-2023. So in other words, for 1 week and 2-month US dollar LIBOR, it could cease at the end of 2021. And for the rest, meaning the overnight 1, 3, 6, and 12-month, it's likely to cease after the 30th of June 2023. So it is expected that when the consultation is finalized, the confirmed end dates for all LIBOR currencies and tenors will be announced, thereby triggering the calculation of the spread adjustment. Other than US dollar LIBOR, which is the overnight 1 month, 3 month, 6 month, 12 month, there is no expectation for other extensions for other LIBOR currency benchmark cessation dates to change. So the end of 2021 remain for the others. It's also expected that US regulators and the FCA will use their powers to limit the use of US dollar LIBOR post-2021 for new issuances. So further clarity on the FCA's use of new powers is expected to come together with the IBA's announcement shortly after the 25th of January 2021, once the consultation end date approaches. So there's lots to look forward to in the month of January of 2021. So what does this mean for you, our clients? So it's the next slide. Thanks, Joe. It is expected that when the consultation is finalized, the confirmed end dates for all LIBOR currencies and tenors will be announced after the consultation results are delivered. So we're thinking or expecting it to be end of January or early Feb. And this could trigger the calculation of spread adjustments with fixing on that announcement date for all of the LIBOR settings. And based on that consultation, US dollar LIBOR is likely to remain representative until their proposed cessation dates, which I'd mentioned earlier. Firms will need to consider the implications that will arise from this staggered cessation, and an extension for US dollar LIBOR, which is what we're expecting to 2023, would allow then in-scope contracts maturing before 2023 to expire without the need for remediation. Other than US dollar LIBOR, there is no expectation, as I mentioned, for the other currency benchmarks to cessation dates to change. So looking at the transition timeline, the next slide, thanks, Joe. Looking at the transition timeline ahead, so this quarter has been particularly busy, as I mentioned, the announcements that just came out, and also looking into the year ahead, there's quite a few coming up. So on this, if you take a look at this slide, so after the IBA's consultation ends, there'll be announcements and, of course, consequences of that announcement, and therefore we may need to adjust this. In the next few months, we're also expecting much activity to meet two milestones in particular. The Bank of England expects to see a significant reduction in GBP LIBOR stock by Q1 of next year. And similarly, the ARC, or the Alternative Risk Rates Committee, the body governing or guiding the transition from US dollar LIBOR to SOFR. The ARC also expects market participants to stop offering new US dollar LIBOR derivatives by Q2 of next year. The target cessation for new GBP LIBOR non-linear and cross-currency derivatives has been set for Q3 of 2021. And all these milestones will require that you understand them and determine how they may impact your portfolio. It's important as well that you start preparing for them now rather than leaving it to later. We will also closely monitor the announcements from the different regulatory bodies and the working groups, and we will endeavor to keep you informed. So if you have any questions in the meantime, your relationship manager is your first point of contact. I will now at this point pass it on to Tek Piao from our compliance team, who will take you through the latest developments with other IBORs. Tek Piao?
Thanks, Kamini. So, as Kamini mentioned, I think with the most recent IBA announcements and the ongoing consultation, so that obviously I think brings up a certain level of uncertainty with regard to cessation, and assuming that the cessations happen as per consulted, I think this will also have corresponding impact on a number of other IBORs. So, as I think some of our clients would know, US dollar LIBOR is actually used in 4 other IBORs that are, I think, fairly used. They are used, I think, quite widely in Asia. So this is for MY4 in India, PHI REF in the Philippines. This is obviously Indian rupee, peso, and in Singapore, it's the swap offer rate store for Sing dollars, and last but not least for baht in Thai baht fix. So US dollars is the US dollar LIBOR is actually a component in each of these ASEAN currencies IBOR computations, and the cessation of US dollar LIBOR now potentially staggered across end of 21 and middle of 23 will have impact on these other ASEAN or Asian IBORs as well. As to how these, I think, ASEAN IBORs will be impacted, I think, as Kamini mentioned, I think we will need to wait for first the result consultation, and that second is that each of these regulators, I'm sure, are also, and the administrators of these IBORs are also monitoring the consultation and the implication on their own IBORs as well. So in Singapore, as some of our Singaporean clients would know, the MAS is also proposing to transition away from SIBOR, which is the other Sing dollar rate. So SIBOR and SOR in Singapore will both be transitioned into the risk-free rate, or the alternative rate known as SORA, which is a Singapore overnight rate average, and that transition is already ongoing. So a couple of other IBORs that have been affected, that have been reformed or discontinued. So we have the Sri Lankan IBOR, which was stopped. The publication was ceased in July this year, and firms on that particular rate was transitioned away into a prime lending rate. Last but not least, in South Africa, there are a number of onshore rates for the rand that is used, and the South African Reserve Bank has been looking at this together with the industry group. So in essence, I think it will be useful for you to actually look at your portfolio in terms of whether it's loans or derivatives or other financial instruments, and then look at whether they are referencing any IBOR rates, because some of these, besides the 5 LIBOR, others are also changing, as you can see here. Next slide, please, Joe. So the next slide talks about other IBORs which are reformed, and I think which some clients have also asked us. So in Thailand, as I've mentioned, Thai baht fix is one of the benchmarks that will be affected by dollar LIBOR cessation, and it will and the Thai authorities, together with Industry Working Group, is proposing that a alternative rate known as the Thai overnight rate, THOR, is used. So, but Thailand also has its own IBOR, that's the Bangkok interbank corporate rate, that will continue to exist. And in Hong Kong, HKMA has also said that HIBOR will continue to be published. There's no plans to discontinue HIBOR. They do mention that HONIA, which is the Hong Kong dollar overnight rate, that is something which I think they're keen for firms to actually do more in. So basically in Hong Kong, HIBOR will coexist next to HONIA. In China, I think for a number of clients, you might also be aware that China is also looking at, I think, quite a fair bit of changes in its orange policy rates. So there was the introduction of a lending prime rate, I think sometime last year, and then the transition into that prime rate. This complements the 7-day repo rate as well as SHIBOR. So we will continue to see, I think, China making tweaks to its rates framework, and for clients with a fair bit of exposure to China and its Chinese rates, right? And we'll find out more. Do reach out to us. Last but not least, for Canada, I think some of you would have seen the administrator of CDOR, which is the Canadian offered rate, actually announced that the 6 and 12 month CDOR will cease from 17th of May 2021. So that announcement came out in mid-November. So what happens is that, as Kamani alluded to earlier, an announcement by the administrator actually triggers the crystallization of the spread, and that was what we've observed with Refinitiv as the administrator announcing the cessation of May next year. So this would be a dress rehearsal for any upcoming announcements involving the 5 LIBORs. So I think the message, I think, across these 2 slides is there are various IBORs and benchmark interest rates that are changing. So it will be useful for you to really have a look at your portfolio outside of the LIBOR as well, to see whether any of these other rates that you are using are affected. So next slide, please, Joe. So I think the next 2 slides cover I think reform status and where we are in the eastern part of the world and the western part of the world. So for the east, right, in Singapore, as I mentioned, we are transiting to SORA, and there have been some SORA facilities loans that have been done already. And for Standard Chartered, we have also done SORA derivatives as well in the OIS format, as well as the cross-currency format involving SOFR. So this is something which I think the authorities in MAS and other industry parties are actively looking at in terms of how Singapore market participants transition to SORA. So do let us know if this is something that interests you. Similarly, we do see in Thailand, again, Bank of Thailand has started really engaging clients, engaging firms on the migration away from Thai baht fix and also the launch of THOR. They've been looking at various ways to spur this, and we can expect a lot more, I think, activities from these 2 markets, as well as India and Philippines on their rates like MIFO and PHI RAP in terms of what they want to do. Last but not least is that we do expect regulators in the region to I think be more proactive about possible industry milestones and timelines in terms of seizing, let's say, a SOR or encouraging firms to stop using LIBOR and things like this. So to that front, Hong Kong MA has already put out circulars for its institutions in terms of milestones on when to cease offering LIBOR, when to start offering RFR rates. Similarly, in Singapore, I think the steering committee for SOR to SORA transition has also looked at industry milestones as well. So we can expect a lot of this to come out, I think, in the coming weeks and months, and obviously it's something which firms like ourselves will be interested, because for banks, we will communicate this, plus we will be engaging clients in terms of your transition to these new rates as well. Next slide, please. So as Kamani said earlier, IBOR reform started with the FCA announcement, but that was actually a broader piece of work at the global level under the Financial Stability Board on interest rate benchmark reforms. So as you may be aware, because of that, that then led to the FCA announcements. And since then, there's been, I think, a bit of things going on, obviously. So within the UK, the transition has been fairly pacey. So the UK risk-free rate, which is SONIA, that has, I think, attracted a good amount of liquidity in the derivatives world. And I think while loans in referencing SONIA is I think still I think much lesser compared to the development in the derivatives world, we are seeing, I think, good traction and momentum. There are more and more transactions taking place for loans referencing SONIA and also referencing SOFR. So you can actually find information on this at the LMA website. And for that, right, I think we will see more and more momentum, and especially now with, I think, more and more firms better understanding this, and also more and more firms, I think, picking up their pace. And I think back to the point that I think regulators still are encouraging firms to actively transition away from LIBOR and when able to really start transacting in RFRs. So with that, I will hand it back to Kamini.
Thank you, Tech Piao. So we move on to the next slide. Thanks, Joe. So in the next few slides, we will be providing a high-level overview of the key updates across the three main asset classes, namely the loans, bonds, and derivatives markets. So on this first slide, in the loans world, the development of LIBOR fallbacks and new RFR documentation have been somewhat fragmented as compared to derivatives, for instance. The fact that the developments are being led at a currency and jurisdictional level has added to the complexity because we now have different currencies progressing at different rates. So this is certainly something to be aware of when clients have existing multi-currency facilities, or you're planning to enter into such a multi-currency facility, for example. So what are some of the key updates for clients in the loan space? So in the Alternative Risk Rates Committee, or the ARC from the US, has published fallback languages for newly originated US dollar LIBOR bilateral business loans. The ARC has also published a technical reference document for syndicated loan conventions. And more recently, the Loan Market Association, or the LMA, published an exposure draft to help in incorporating pre-agreed conversion terms for multi-currency loan transactions. The Sterling Risk-Free Rate Working Group from the Bank of England has also provided recommendations on the credit adjustment spread methodology for fallbacks in cash products, and they've also published a paper on active transition of GBP LIBOR loans. So with all of these developments in recent months, what can you expect from us? So the bank will be reaching out to you, our clients, particularly the ones with LIBOR-linked loans, to communicate what the next steps are and what your transition options might be. RMs are undertaking an exercise which commenced last month to reach out to borrowing clients and have these prepare type discussions with you, gauge what the client awareness is like, and what your preparation and readiness might be like to start transacting in RFRs. And we'll keep you informed throughout this process and keep providing you with updates in relation to further market developments. You can always reach out to your relationship manager and follow up on this as well. In terms of new RFR loans, while it's comparatively slower than in the derivatives market or the bonds market, several RFR-based loans have been transacted, and Arpit will speak about these a little bit more in detail later. The transition to alternative reference rates is already underway in the GBP LIBOR loan market, and there have been borrowers entering into bilateral SONIA loans, for example, and where they've amended their GBP LIBOR reference loans to SONIA. And there's also been activity in the syndicated loan market with a very publicized deal with British American Tobacco and their multi-currency facility agreement, which included an inbuilt switch from GBP LIBOR and US dollar LIBOR to SONIA and SOFR. So these transactions are showing us that there is an appetite to start transitioning away from LIBOR now, and it's also helpful for borrowers and lenders to consider this in their plans. Standard Chartered Bank currently have capabilities to transact in new RFR-linked loans, and we continue to enhance our systems to further expand our loan product offerings. We've completed the first phase of enhancements to our commercial loan booking system, and this enables the support of bilateral and syndicated loans where the bank is not an agent bank. So again, you can always reach out to your relationship manager to find out more with respect to our capabilities in the loan space. So moving on to the next slide on bonds. So similar to the loans market, the development across the bonds market has been led by different working groups and industry bodies. In relation to fallbacks, the International Capital Market Association, or ICMA, has published a guide to the transition to risk-free rates in the international bond market. So this guide contains information on conventions, fallbacks, and spread adjustments. Additionally, the ARC has published recommendations on more robust fallback language for new issuances of US dollar LIBOR floating rate notes. The Sterling RFR Working Group out of the Bank of England has also published a paper on active transition of GBP LIBOR bonds. So the bank will reach out to our clients with the LIBOR-linked loans likely in early 2021, and we'll communicate the next steps and transition options, and we'll keep you informed throughout this process as well. In relation to new RFR bonds, these have been issued in the market, and it appears that the SONIA bond market is quite advanced as compared with other RFRs. New GBP SONIA bonds have been issued along with a number of consent solicitations to convert GBP LIBOR to SONIA. There's also been an increase in the issuance of US SOFR bonds. However, the market conventions for bonds is still very much in development, and this, by market conventions, I mean the methodologies such as look-back, payment delay, lockout, etc. So currently, the bank does have capabilities to offer RFR-linked bonds, and we're able to support the issuance of these bonds based on the client's needs. So again, please reach out to your relationship manager to find out more on this. Now, for the next section on the derivatives market, I'm going to pass you on to Ryan Goh from the rates trading team, who will talk you through these important updates. Ryan?
Thank you, Kamini. So in this slide, we will touch upon some of the key developments and updates from the derivatives market. Now, the month of October marks a significant milestone in the whole IBOR transition progress, especially with ISDA launching the ISDA protocol, as well as the amendments to the 2006 ISDA definitions. Now, this document has been a work in progress involving multiple industry participants, and it has gone through a variety of feedback and consultations. Now, the key point of this will be to look at how legacy derivative contracts should fall back once LIBOR ceases to exist. Now, it's imperative to note that the existing 2006 ISDA definitions can only cater for a temporary cessation of LIBOR, perhaps due to a market disruption event of sorts, and not a permanent one. As a brief recap, LIBOR will fall back to the respective compounded risk-free rates, also known as RFR, plus a certain spread adjustment. Now, this spread adjustment is necessary to account for the credit and term premium that is present in LIBOR, but not the risk-free rates. Now, the industry body has essentially voted for a 5-year median look-back approach for this spread adjustment. Now, using US dollar 3 months LIBOR as an example, what we'll do is that we'll look back over 5 years of data, and for each day, compute the spread between US dollar 3-month LIBOR as well as compounded SOFR over 3 months. And then the median will be taken, over this whole data set, and that will be used as spread adjustments henceforth. Now, we'll start to reach out to clients to understand their position with regards to the protocol adherence. As Kamini mentioned, as a bank, we intend to adhere to the protocol, and we'll look to begin conversations on this soon. It is also noteworthy that ISDA targets January 2021 as the effective date for the supplement and protocol. So this gives us roughly about 1 to 2 months of discussions and to understand things from a systems perspective and also how to manage one's derivative exposure. Now, before we embark onto the next slide, we will touch on liquidity in the risk-free rate markets. I'd like to highlight some points in the timeline. So, as seen in this particular slide, some of the timelines were actually revised based on the, industry consultation by the IBA, FCA, and the Fed with regards to the recent announcements that company touched upon. One key thing to note is that these targets will kind of come swiftly as we move into the next year, and that we'll continue to monitor and provide updates with regards to the liquidity of the risk rate markets, as we head into 2021. Can we move on to the next slide, please, Joe? Thank you. So now in this slide, as mentioned, the month of October was an important one for IBOR transition, especially since clearinghouses have transitioned from using Fed funds for the price alignment interest, also known as discounting, to SOFR, for cleared US dollar derivatives. Now the discounting switch from Fed funds to SOFR, as well as the concomitant auctions for the SOFR Fed funds basis swaps, has resulted in a significant increase in SOFR trade counts as well as volumes for the month of October, with volumes roughly 4 to 5 times the monthly average. Nonetheless, there are still some marked differences in what we are seeing now in terms of the liquidity of the risk-free rate markets. The chart on the left illustrates the trade count and notional differences between SONIA for the UK, SOFR for the US, Aster for the Eurozone. So SONIA notionals and trade count dominate the other two marketplaces, even though the UK derivatives market is smaller than its US and European counterparts. So, as a comparison, right, the ratio of SONIA versus sterling LIBOR derivatives volume is now roughly at around 50%. And this is a considerable pickup from last year, where the ratio was roughly 30% SONIA versus 70% sterling LIBOR. Now, looking at SOFR, the ratio is much smaller, and it stands roughly around 2% of the total US dollar derivatives markets right now. However, the discount switch for cleared US dollar derivatives at the clearinghouses should provide a positive catalyst to engender higher risk-free rate derivatives volume moving forward. The chart on the right illustrates risk-free rate volumes for issuances, and in this regard, SOFR clearly dominates over SONIA and Aster, and this more accurately represents the relative sizes for the US market versus the UK and the Eurozone. It also suggests increased investors' confidence in the risk-free rate adoption in the floating rate note space, as SOFR gradually becomes the replacement for the US dollar LIBOR benchmark. Can we move on to the next slide? So I'd like to conclude my portion with a discussion of the bank's capabilities in the risk-free rate derivative space. Now in the G5, that is the US, UK, Europe, Japan, Switzerland, Standard Chartered is able to offer linear derivatives, both as an outright, in other words, fixed versus compounded risk-free rates as float, as well as basis swaps, which means compounded risk-free rate on one leg versus the corresponding IBOR on the other. Now, the tenor limits are adjusted depending on the liquidity of the risk-free rate markets. We are able to offer up to 30 years in most markets, with the exception of Switzerland and Singapore. Now, speaking of Singapore, we offer SORA derivatives after 10 years. Now, volumes are increasing slowly, but we are still seeing good support from the regulator, in this case, the Monetary Authority of Singapore, also known as the MAS, to grow the market accordingly. Now, as the bank, Standard Chartered have recently participated in 2 of the world's first cross-currency basis swap, referencing the risk-free rates. The first is being SOFR versus the China 7-day repo rate, as well as SOFR versus CLIBOR, which is the Malaysian benchmark. Now, the cross-currency swap market is still developing slower than what we would like, but we'll most likely see a pickup going to next year when the CSA starts to convert from Fed funds to SOFR, together with increased market confidence in the risk-free rates. Now, on our end, we'll monitor the situation closely and provide updates when there are notable developments in liquidity. I'll now like to pass on my time to Arpit, who will discuss the developments of risk-free rates in the loan space. Arpit?
Thank you, Ryan. So the adoption of RFR rates have posed varying degree of challenges. Ryan earlier touched on some of the challenges in derivative markets. Those were particularly in liquidity and volume space. When it comes to loan markets, the challenges are slightly different to derivatives. Loan market was heavily reliant on LIBOR term structure, and it has now to switch to an overnight RFR rate. To overcome the non-availability of a forward-looking term structure, a number of new alternative methodologies have emerged in the space. In the next couple of slides, we'll be covering RFR-linked interest calculation methodologies and the associated conventions. So let's look at the RFR interest calculation methodologies first. And we have a couple of options right now with us. They are compounded in arrears and simple interest. As the naming convention suggests, compounding involves compounding of RFR rates over the relevant observation period, while on the other hand, simple interest is simple arithmetic mean of the daily RFR published. As you can see on the screen, there are broadly 4 distinct conventions, and they are lag or look back, lockout with true up, delayed billing, and lockout with no true up. The notes on the slide describe each interest computation methods in details and also cover the bank status, which is also aligned to the market. Later on, I'll be highlighting few RFR loans that have been executed till date and the methodologies that have been used. But let's understand these methodologies in detail first with help of a chart that is included on the next slide. On this slide, each of the 4 methods of RFR interest calculation is graphically shown. We'll use an example of a term loan which is drawn on 1st January 2021 and where the interest is settled on a quarterly basis to understand these methodologies. We'll start with the base case scenario first. That's the first scenario on top of your screen. In the base case, the observation period is identical to the interest period. That is, the loan will be dispersed at the start of the period, which is 1st January 2021, and the interest will be due on the last day of the period, which is 31st of March. But given the publication timing of most RFRs, this method has a disadvantage. It requires the payment on the same day that the final interest payment amount is known. In our example, that day will be on 31st of March 2021. And as a result, this makes this impractical for use. So as we've discussed earlier, let's look at the 4 conventions which we have. The first one is lockout. In this option, the RFR is no longer updated, or it can be said it's frozen for a certain number of days prior to the end of the interest period. In our example, the lockout period is between 25th of March to 31st of March, and that is also highlighted in orange on our chart. During this time, RFR of the day prior to the start of the lockout period, that is of 25th of March, is applied for the remaining days of the interest period. As a result, the RFR rate to be settled can be calculated before the end of the interest period. Let's look at the second convention, that's lockout with true up. This option behaves in an identical manner to the lockout method discussed earlier. The only difference is that any interest rate differential between the actual rate of the lockout period and the frozen rate is trued up in the next interest cycle. This is shown in the chart in the darker shade of blue. Third option is payment delay. So in contrast to the base case, the interest payment in this methodology is delayed by a certain number of days and are thus due few days after the end of the interest period. In our example, the interest accrued for 3 months ending 31st of March will be cash settled on 4th of April. Lastly, the 4th method is look back. So in contrast to the base case again, the observation period for the interest rate calculation starts and ends a certain number of days prior to the interest period. In our example, this observation period will start on 25th of December and will end on 25th of March. And as a result, the interest payment can be calculated prior to the interest period. At this point, let's look at what's happening in the street and what kind of transactions have been entered into. So based on the information which is publicly available and also published on the LMA website, there are only a small number of RFR-based loans that have been entered till date. Mostly, they are using compounded in arrears methodologies of computation of interest together with a look-back convention. Some of the major deals are done in Europe and they are mostly referencing SONIA. To call out few would be Innova Energy and Coastline Housing, both of which are SONIA-based bilateral term loans. Then we have Southwest Water, and we have Tesco PLC deal, which is a syndicated transaction of 15 lenders. It is a revolving credit facility, which is available for drawdown in 3 currencies, which are pound sterling, euro, and US dollar. An extensive list of such deals are available on the LMA website. But what is common in all these deals is the fact that they are using compounding in arrears methodology together with a look-back convention, where generally a 5-day convention is being followed. While these transactions are mostly bilateral in nature, a variant of RFR loan was also entered into in December of last year, where Royal Dutch Shell signed a new English law US dollar syndicated revolving credit facility, which initially references LIBOR, but it includes a mechanism whereby at a specified date, the transaction will switch to a compounded SOFR. This is commonly known as a deal with a switch mechanism. A slight variant of the Royal Dutch Shell deal was also announced in March of this year, where British American Tobacco entered into a multi-currency facilities referencing RFR. But by and large, we have not seen any significant transition away from LIBOR to any other pricing alternative when it comes to loan. Moving on. This slide covers the Standard Chartered capabilities for lending in cash products. At present, we are offering bilateral and syndicated RFR facilities where the bank is not an agent, covering SONIA, SOFR, and Nestor rates. This product is currently available for 20 booking locations. Please note, if you want to know the details of these booking locations, it's available on request. For those syndicated loans where bank is also acting as agent, this product is currently supported on a limited basis and is currently restricted up to 10 lenders. For the remaining IBOR currencies, that is Swiss franc and yen, the offerings are on case-by-case basis. Lastly, on loans, SORA offerings are also aligned to our offerings for SONIA, SOFR, and Nestor. This is all for loans. For the trade products, which are generally shorter dated in nature and heavily reliant on term structure, for such products, the current pricing will continue to apply. We are monitoring this space, and the RFR pricing will be made available ahead of the GBP and USD timelines in 2021. At this point, I will pass on to my colleague, Tek Piao, who will take us through the forward-looking rates in RFR. Over to you, Tek Piao.
Thanks, Abid. So I think we've spoken a lot about RFRs and where they are and how the products in terms of derivatives, loans, and bonds are adapting to this new world. And as Kani mentioned early on, RFRs and LIBORs are quite fundamentally different. So there are, I think, initiatives ongoing whereby the RFRs, the various working groups are essentially looking at whether a forward-looking term RFR is possible. So why? I think the question is why. So for a number of reasons. First is that there are certain products where a forward-looking term rate is actually needed due to structural issues. So for example, in the derivatives world, we've got certain instruments like cap floors, FRAs, where you do need a term rate. And in the loans world, certain things like, let's say, Islamic finance, as well as in the trade world, again, term rates are something that I think will be very useful. So that's one reason. Second reason is that in certain cases, clients have said that they actually need more time to look at their interest payments because, as Abid mentioned, for loans, for example, the convention involving a compounded RFR could mean that a client has possibly 5 days or less to actually arrange for payment, whereas in the LIBOR world, a client could have up to 30 days or more to arrange for interest payment. So certain clients may want a forward rate so that they have more time as well as to arrange their own payments and cash flows. So I think on this front, so what has happened is that the UK Sterling Risk Rate Working Group has in a way looked at this, and in a report it mentioned that up to 90% of the sterling market can potentially use SONIA compounded in arrears. However, 10% may not find this methodology suitable, and this includes some of the examples that I've said, which is Islamic banking, trade type products. So in this regard, what has happened is that there are initiatives underway. So in the UK, I think 3 administrators have started publishing beta versions of a term SONIA. Expectations is that a final version will hopefully be out towards the end of this year, early next year. A current RFQ process is ongoing to look for administrator for term SOFR, so that's for US dollars. Then similarly, in Japan, a administrator has been found for a term IFR term toner, and is starting to get published in beta format. Last but not least, in euros. The process will kick off for term master will actually kick off early next year. So as you can see, a lot of these development of term RFRs are still in progress, and there is actually no certainty that they will get developed. Even if they're developed, what kind of use they will be meant for. So in this regard, I think the regulators have been consistently saying that I think the industry should not wait for forward-looking RFRs to become available, and if they can, to transition away using RFR in arrears or other methodology. So that's been a consistent message that clients should not wait for term RFRs if possible. So I think, so as far as clients are concerned, I think do have a look at your portfolios and determine whether you have any instruments that you are using facing us or other banks, whereby there is a need for a term RFR or a term rate. And then from there, right, really the discussion is to be had with your bank and us to really look at what are the solutions possible. Next slide, please. So this slide actually summarizes the developments I've mentioned, and I think I would close here by saying that, as mentioned, the term rates are in development, but again, repeating the point that no certainty that they will get developed, and they will get developed in time. So again, do look at your portfolio, do look at whether it's possible for you to use the other methodologies, and have that conversation with us when you are ready to do so. So with that, I will hand this back to Kamini.
Thank you, Tech Piao. So moving on to the next slide. Thanks, Joe. So we, as I mentioned at the beginning, we have compiled a readiness checklist, which some of you would have received the link to client outreach emails that were sent out in Q3 of this year. So here on this slide, we list a number of items for you to consider in your preparation towards the RFRs market. I won't read all of them out, but a quick run through here. Staying constantly updated and keeping yourself updated and understanding the key developments with regards to the transition is really important. We encourage you to keep yourselves up to date with our transition plans as Standard Chartered, which includes our RFR capabilities and also the adoption of the key transition milestones. So you can participate in webinars like this one and keep abreast of developments from regulators and industry working groups, all of whom run webinars that are publicly available for you to join. You should also assess the likely impact of the transition on your portfolio, what your exposures might be, and also consider seeking independent advice where it may be required. Determining the legal impact, the implications on contractual terms such as triggers and the legal interpretation of fallbacks, accounting considerations, assessing the fair value changes and the reporting implications that need to be recorded, and also identifying any potential tax implications which may arise due to the modification of your current LIBOR contracts and the active conversion potentially to a new RFR-based contract. Again, here it's advisable to engage independent consultants to understand what the financial reporting and taxation implications might be. On the operational side, getting your systems and documentation and processes updated in terms of system enhancements or updates. It's important to not only have these changes implemented, but also have them tested and validated in time for the transition. In certain cases, businesses may need to liaise with third-party system providers regarding, upgrades and enhancements. And on the documentation side, it includes policy, procedure updates, etc. There are other points on here, but the final one I'd like to mention is communicating with your impacted parties, meaning your counterparties, your vendors, your employees. This is quite a key aspect to managing the impact as well. On the next slide. So what are we doing to respond to this? So at Standard Chartered, we do acknowledge the importance of the IBOR transition and its impact on our clients. And we responded in a number of ways. So we've established the Central Global IBOR Transition Program. And what we do at the program is we ensure that all aspects of the transition are considered. And we have an enterprise-wide approach to ensuring we mitigate the risks and manage the transition properly across our various client groups. We do participate actively in industry working groups, and this allows us to be at the forefront of the latest market developments and the best practices. We monitor ongoing developments associated with the transition, for instance, announcements and publications that are issued by regulatory bodies, such as last week's IBA announcement and those from ISDA or ARC or LMA, etc. Importantly, we ensure that everyone at the bank understands the importance of the transition, its impact and the impact on clients, and we do conduct extensive training for our frontline teams on a regular basis. And finally, we're continually introducing RFR-linked products, and we're developing our capabilities. So again, you can reach out to your relationship managers to understand what our latest offering might be. On the next slide, thanks, Joe. So what are the next steps? So we will be actively engaging and supporting you throughout this transition. You may have already received emails from us since the beginning of this year, and these were sent out to inform you of the transition, provide you with links to different and relevant resources, etc. As I mentioned, this last quarter, particularly for our borrowing clients, your relationship managers have been reaching out to you to commence the more targeted engagement around your exposures that you may have with us. These talks are really to prepare you and to help you understand what options you may have to either actively convert or to amend your contract from LIBOR to an RFR, or to include fallback language in an existing contract, amend the fallback language rather. So the actual remediation activities will commence from Q1 of next year, and we will be arranging a time to talk you through these. So as I mentioned, in the meantime, there are all these checklists and resources that we've provided. Just onto the next slide, please, Joe. So we've got a list of materials here that are available to you, and these are later this week, as I mentioned, you will receive an email from us with a link to the site that will have the recording of today's session, as well as these slides, which have the hyperlinks in there, and you can easily access them. If you do want the PDF version of these documents as well, you can just write to us and we'll send it to you. And our email address is ibor.transition@sc.com. Now, with that, it brings us to the close of our presentation. We do have a few questions that have been posted on the panel here on the right. And I might just go through some of them. They have been answered by our panelists. We have got our team of business stakeholders as well as legal and conduct colleagues that are also on this call, and they've addressed most of your questions here. So the first question was from someone anonymous around the possibility, is there a possibility that the spread added to loan as a result of the transition is different from the spread added to in favor of a corporate paying a fixed rate under the interest rate swaps, and the possibility that this could end up in a loss? Amit Shah, who from our legal team has answered it, but has urged you to please contact him and have a direct conversation. Amit's email address is in response to that question. It's amit.shah@sc.com. We are trying to, or we do aim to make the transition value neutral. So, in your specific case, we really need to understand what your products are with us, and we can discuss with you exactly what that would mean for you. But as Amit has pointed out here, the objective is to make this as value neutral as we possibly can. Now, we do have a second question that's quite complex, and to answer it, and we didn't want to post a written response here. It's the second one asking around cross-currency swaps. So how will the spread adjustment on the US dollar LIBOR leg be converted to the other currency leg? So for example, SOL plus X, etc. I've got Ryan on the line. Ryan's from our rates team. Ryan, did you want to perhaps attempt to respond to this question? I know there's a few angles to answer this, but if you could perhaps address some parts of it.
Yeah, sure, Kamini. So I'll address and I'll try my best to address this question, and my colleague Teck Piao can actually add on to it. So for cross-currency swaps, it's a little bit more complicated, really, because by definition, the two legs are of different currencies. So perhaps let's say a sterling dollar cross-currency swaps as an example. So on one leg we have sterling LIBOR, and on the other leg we have US dollar LIBOR. So originally at trade inception, let's say the sterling LIBOR leg is sterling LIBOR plus a 20 basis point spread versus a US dollar LIBOR leg plus 0 basis points. In other words, flat spread. So post this whole IBOR discontinuation, we already know that sterling LIBOR will fall back to compounded SONIA plus the ISDA spread adjustment for SONIA, and US dollar LIBOR will fall back to compounded SOFR plus the ISDA spread adjustment for US dollar LIBOR. So in this regard, this sterling dollar cross-currency swap would fall back to, on the sterling leg, it'll be sterling compounded SONIA plus the ISDA spread adjustment for SONIA plus the original 20 basis points spread. And then on the US dollar LIBOR leg, it will fall back to compounded SOFR over 3 months plus the ISDA spread adjustment for the 3-month dollar LIBOR. So hopefully this helped to clarify. Maybe perhaps Teck Piao can add on to my response.
Yeah, sure, Ryan. So as Ryan mentioned, right, I think cross-currency swaps is particularly tricky because you do have multiple permutations. And I think the question also touched on SOR and Thai baht fix. So in the case of SOR and Thai baht fix, it does fall back to adjusted SOR and adjusted Thai baht fix. So whereby the dollar component is actually swapped in for the corresponding SOR component. So I think another sort of area that I think you want to think about is obviously for cross-currency swaps, a lot of us are using such swaps to hedge certain underlier, whether it's loans or bonds or other things. So then the question is that if you are using that, how does the hedge, the cash product, whether it's a loan or others, how does that affect? How does the fallback in the cross-currency swaps affect your loan? Because assuming your loan is, let's say, dollars. I think that's one. Then second is that obviously in the cross-currency swap world, it's also possible that you have a cross-currency swap, let's say referencing dollars and let's say ringgit, whereby the ringgit leg or let's say the Hong Kong dollar leg remains on the onshore IBOR, CLIBOR, and let's say HIBOR in Hong Kong. That is not changing. But there is a possibility, obviously, that the dollar leg, which is referencing LIBOR, will fall back to SOFR. So again, how that affects the hedge, and also the basis that could potentially arise. So cross-currency swaps are, I think, trickier to deal with, and if there are specific examples, right, do reach out to your RMs and we can have a look at that particular set of scenarios. Kamini?
Thank you, Teck Piao. Let me just look through some of the questions. We've had quite a few responses anyway, and so people can definitely read it for themselves. One that's probably of interest to a few people, which is from Mr. Vipul Desai. So just give me a second. My screen is playing up. So we did have one question here around the fallback. So the question was around, we've done the interest rate swap for our term loan with the interest rate linked to LIBOR so as to have agreed the fixed interest rate for the remaining tenure of the loan. Hope this will not change in the future. So Richard Lau from our corporate finance team has answered this, but Mr. Desai, simply the fallback language in our existing loans has catered for a temporary cessation of LIBOR. They will need to be amended depending on the expiration of your or the maturity of your loan. It will need to be amended such that the fallback language caters for a permanent cessation of LIBOR. So this is something, as you've noted here, you will take it up with your Standard Chartered Uganda team, and that's probably the best next for you. But also they will connect you with us if you wanted to discuss this further. We did have a question as well from Hannah Nares around compounding, and hi Hannah, I think RT has actually responded to you. Your question was around compounding. Do we compound only the risk-free rate or the all-in rate? And RT has responded by saying that the compounding is applied on the risk-free rate only, not the all-in rate. I'm not sure, Hannah, why you feel the question's been removed, but it still is there, and hopefully you can see it. And if you are having difficulty picking up the response, you can email us, and we can pick up the discussion with you as well. There is another question as well from George Nahas around the spread adjustment and the term rate. George, Richard Lau has responded to you. If there's a follow-up question from you, please do reach out to us. We are on 6 o'clock exactly, and I don't want to overstep the time because you've been with us for an hour already. I'd like to thank everyone for joining our session today. It's been a good set of questions. As I mentioned, we will be sending you the slides as well as the recording of today's session. But if there are any other questions, please don't hesitate to reach out to the team at ibor.transition@sc.com. Thank you, everyone, and have a good day and evening wherever you are.